Hey, Steve Saretsky here. As always, Canadian real estate market update, a particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask you to hit thumbs up and subscribe. Questions, comments, put those below. I wanted to make this video sort of a year-end special, basically summarizing my thoughts on the year that was and sort of as we enter into 2021, the things that I'm kind of watching, moving forward. But as a holiday special video here, the Christmas special, as you will, I want to sort of give it back to you and show my appreciation for your support. This channel and this community continues to grow every week, so very supportive of that. I actually want to say that this was the best book that I read this year. It's called The Psychology of Money by Morgan Housel. Really a interesting creative spin on personal finance. It's a very digestible book, actually quite entertaining, short, concise. It was one of the best sellers this year and definitely was my favorite book. So as a thank you to you, the community, I'm going to give away 3 copies of this book. So I'll basically just pick 3 random people. If you want to just comment below, why I should give it to you, why you want it, etc. I'll just randomly pick 3 people. But I wanted to touch on my thoughts here because I put out a video last week on basically how the Bank of Canada said there was no froth in the housing market and that they were going to continue to engage in these QE programs moving forward into the recovery, which they sort of foresee in 2023. Now, I think it's important to contextualize because, with that sort of framework, there's a lot of people that were upset or, they let their emotions get ahead of themselves. Their emotions are dictating things rather than being agnostic and strictly looking at things from an investment perspective. What I'm focused on in my life and what I try to emphasize in this channel is trying to be, again, agnostic, and the ultimate goal here is having a dialogue around wealth preservation and protecting your hard-earned capital. I mean, everybody here that's watching, I'm assuming, is working fairly hard for a living. Whether you're 9 to 5 or you're running your own business, the most important thing is now trying to preserve that capital that you've worked so hard for. So I try not to let my emotions get in the way of my personal investing philosophy, and I think that book that I just recommended should certainly help you do that. So when I look at the central banks and what they're doing, is that I don't necessarily agree with those policies. I don't think that these are the best policies for society, or that by doing these policies there aren't going to be serious repercussions from a societal perspective. But at the end of the day, I'm not going to go out and fight those policies just because I think it's the wrong thing to do or immoral or whatever. My job, again, is to preserve my capital. So people ask why I got bullish on housing despite these mortgage deferrals, etc. Is if you actually look at quantitative easing, the definition of QE, or one of the desired outcomes of QE, was actually described on the Bank of England's website. Now, don't forget that the governor of the Bank of England, Mark Carney, the ex-governor of the Bank of England, Mark Carney, was also the former head of the Bank of Canada. So just what the Bank of England has basically called QE is quantitative easing. QE involves large-scale purchases of government bonds which lower the interest rates or yields on those bonds. This pushes down on the interest rates offered on loans, for example, mortgages or business loans, and is designed to stimulate the economy by boosting a wide range of financial asset prices. So it's implicit in the quantitative easing mandate. The goal is to elevate the prices of financial assets. So their goal is to explicitly push the value and the prices of real estate higher. So why, as an individual like myself, why do I want to fight that and say, well, if these guys that are the only people that have control over the money supply, if they're putting out a policy that explicitly states we're going to try to raise the value of real estate prices, why would I be bearish, and why would I try to fight that? Again, I don't agree with the policy, but this isn't for me to decide. So again, whether or not you agree the central banks have the power and wherewithal to do that, and eventually there'll be some sort of slip up and there'll be a mistake and things will eventually blow up, I don't rule that out as a possibility down the road. But in the near term and in the medium term, these are their policy objectives, and I don't want to implicitly fight a policy that is designed to raise real estate prices. Now again, it's kind of ironic because obviously the government and the policymakers always talk about, housing affordability and elevated levels of debt, and we need to be careful. It's basically just lip service. At the end of the day, the central banks are going to do what they're going to do, and that is to go back to the well into the quantitative easing programs. And as I've said, and as Tiff Macklem eloquently put it in his interview just over a week ago, the next move as we look into 2021 year end here is some form of yield curve control when yields start to rise higher than the Bank of Canada or central banks for that matter can tolerate. So Tiff Macklem's comments right here.
Let me put it in a little bit of a broader context. We've indicated for some time that if we need to do more, we have a range of tools. That would include scaling up our quantitative easing program. We could, as we did last time, shift purchases further out the yield curve, which would have the effect of increasing the stimulative impact, further increasing the stimulative impact. We could use yield curve control. Some other central banks are targeting certain parts of the yield curve. That's an option. And getting to the couple of options you highlighted, there is also the possibility of lowering the effective lower bound from its current rate of 25 basis points to something that is still positive. Some central banks have even gone into negative territory. As we've indicated a number of times, the bar to go into negative territory would be particularly high. At least in the Canadian context, it looks more disruptive than helpful. So it is in the toolkit. So we could use it, but we've certainly indicated on a number of occasions that the bar to do it would be quite high.
So again, these programs are all designed around elevating the level of financial asset prices. The hopes of that is that through that you'll create a wealth effect, which then generates further consumption, consumer spending in the economy. And again, 65% of GDP is consumer spending. So by raising asset prices, creating a wealth effect, encouraging people to then go out and spend that new home equity creates further GDP growth. And one man's income, as Ray Dalio calls it, one man's spending is another man's income. And so even though, again, as we move into year end, looking forward here, a couple charts that I want you to keep in mind is you have a scenario where, yes, the underlying economy does not look great. In fact, we can actually look at leading indicators are once again all rolling over. So I think that very well we'll end up in some sort of double dip recession at the beginning of Q1, particularly with all these lockdowns and the resurgence of the virus. But again, that hasn't mattered. That hasn't mattered for the past 8 or 9 months in financial markets. And so I don't suspect it's going to matter, because at the end of the day is you have fiscal spending and monetary policy, which is basically overwhelming the negative impacts of this economic calamity and these shutdowns. Now, again, that's not to say that every household is the same, that there aren't people out there hurting, there aren't going to be a lot of businesses that go insolvent, there are going to people that suffer. But the overwhelming consensus, if you look at the data, is financial markets are telling you what they think, and they're ripping higher. And you have, take a look at the Canadian households' checking accounts. The growth of their deposits is through the roof, and they're sitting on over $90 billion of spare cash. And this is again because you have the fiscal and monetary policy overwhelming the negative impacts of of what's happening in the real economy. So that's kind of where I'm framing things up moving into 2021. I still think, yes, there might be a double dip recession, but I think that financial markets will continue to shrug that off simply on the basis of what we're seeing on the fiscal and monetary side. So I'll kind of leave that with you. I'm kind of curious to actually what I want to do here in the next few days, if I can hear your comments and feedback below as well, is I want to do sort of we did this at the beginning of the pandemic, is I want to do another Q&A. So I'll either do that on YouTube through a live YouTube upload here, a live stream on YouTube, or through my Zoom account where we sign up for a webinar, which is what we did last time. So I'm kind of curious to hear your thoughts on what you think might be a better platform. Should we do the YouTube live, or should we go through a Zoom webinar in terms of a Q&A, just having a holiday sort of get-together dialogue around financial markets, Q&A, ask me anything sort of thing. But I want to wish you, again, a Merry Christmas, a Happy New Year. What the plans are to do that Q&A towards the end of the year, maybe on the 30th or 31st. And we'll see you soon. So thanks for tuning in. Subscribe, thumbs up. See you next week.